Imagine this. You walk into a store and instead of asking, "Can I afford this?" you ask a different question: "What's the monthly payment?" Car. Monthly payment. Phone. Monthly payment. Furniture. Monthly payment. Vacation. Monthly payment. Now imagine you finance almost everything in your life. On the surface, it feels manageable. $50 here. $300 there. $800 for the car. Nothing seems catastrophic. But what happens when you zoom out and look at the long-term math? Let's break it down. Financing turns big prices into small pieces. A $1,000 phone doesn't feel like $1,000. It feels like $41 a month. A $35,000 car doesn't feel like $35,000. It feels like $620 per month. Your brain is wired to focus on the monthly number, not the total cost. But the bank doesn't think monthly. The bank thinks total plus interest. Let's take a simple example. You finance a $30,000 car at 7% for 6 years. Your monthly payment might be around $511. Over 6 years, you don't pay $30,000. You pay closer to $36,800. That's nearly $7,000 extra just for the privilege of paying slowly. Now multiply that behavior across your life. A financed car. A financed phone. A financed laptop. A financed couch. Credit card balances rolling every month at 20% interest. Individually, each one feels small. Together, they quietly build a fixed payment lifestyle. Your future income is already spoken for. Here's where the long-term math gets serious. Every dollar you commit to payments is a dollar you cannot invest. If you pay $600 a month toward consumer debt instead of investing it, and that $600 could have earned 8% annually in the market, over 30 years that's not just $600 times 12 times 30. It's over $800,000 in potential growth. That's the hidden cost of financing everything. It's not just interest. It's opportunity cost. And opportunity cost compounds. When your financial life is built around payments, you become extremely sensitive to income disruption. Lose your job for 3 months? The payments don't pause. Get sick? The bank still wants its money. The more you finance, the less flexible your life becomes. At some point, you're no longer working to build wealth. You're working to maintain payments. And that's a very different future. Now let's go deeper into the psychology. Financing everything changes how you see money. Instead of thinking in terms of ownership, you start thinking in terms of access. You don't own the car, the bank does. You don't fully own the phone, the contract does. You don't own your income, your payments do. This creates what I call a permanent middle-class trap. Your income rises, but your payments rise with it. You get a raise? You upgrade the car. You upgrade the apartment. You upgrade the lifestyle on credit. The problem is simple math. Let's say you earn $5,000 per month after taxes. If $2,000 of that goes to fixed payments, car, credit cards, personal loans, subscriptions, you only truly control $3,000. Your financial freedom is already cut by 40%. Now imagine you invest instead of finance. If instead of financing furniture at 10% interest, you save for 6 months and pay cash, you avoid interest. That alone is a guaranteed return equal to the interest rate. Avoiding 10% interest is the same as earning 10% risk-free. But when you finance everything, you are consistently earning negative returns. You are paying the bank's profits instead of collecting them. There's also inflation to consider. Many people argue that inflation makes debt cheaper. And yes, fixed-rate debt can lose value in real terms over time. But that only works in your favor if your income rises faster than your payments and if the debt is tied to appreciating assets. A house with a fixed mortgage at a low rate can be strategic debt. A depreciating car at a high interest rate is usually not. The long-term math becomes brutal when you combine depreciation with interest. You're paying interest on something that is losing value every year. Let's say you finance a $40,000 car. After 5 years, it may be worth $18,000. But you might have paid $45,000 or more in total. You lose on both sides, value and interest. Now imagine repeating that cycle every 6 years for 30 years. That's 5 cars. Possibly over $200,000 spent, not including insurance, maintenance, and fuel. And what if instead you drove reliable used cars and invested the difference? That difference alone could grow into hundreds of thousands of dollars by retirement. The question isn't whether financing is evil. The question is whether you understand the math you're signing. Because every signature today writes a line in your financial future. Now let's talk about what financing everything does to your timeline. Wealth is not built by income alone. It's built by ownership. Ownership of assets. Ownership of investments. Ownership of cash flow. When you finance everything, you delay ownership. Sometimes for years. And here's the key idea: time is the most valuable financial asset you have. If you start investing at 25 and earn 8% annually, your money has decades to compound. But if your 20s and 30s are consumed by car loans, credit cards, and consumer financing, you don't just lose money. You lose time. And time doesn't come back. Let's compare two people. Person A finances everything. They have constant payments and start investing seriously at 40. Person B avoids unnecessary debt, keeps expenses low, and starts investing at 25. Even if both invest the same amount later, Person B can end up with 2 or 3 times more wealth by retirement simply because of earlier compounding. This is the invisible cost of buy now, pay later. You are borrowing from your future self. And your future self pays with lost growth. There's also stress. Financial stress compounds just like money does. High fixed payments reduce risk tolerance. You're less likely to change careers, start a business, move cities, or take opportunities. Debt quietly limits your options. When most of your income is already committed, freedom shrinks. But here's the balanced view. Not all debt is bad. Strategic debt used to acquire appreciating assets or increase earning power can make sense. A reasonable mortgage. Education that increases income. Business investment with clear upside. The problem isn't financing occasionally. The problem is building a lifestyle where everything is financed. Because in that world, your paycheck is already spent before you earn it. The long-term math is simple but powerful. Interest works for you or against you. Compounding builds wealth or builds payments. Ownership creates freedom, payments create obligation. So the real question isn't, can I afford the monthly payment? The real question is, what is this costing my future? And when you start asking that question consistently, your financial life begins to change.